Hi, good afternoon, everyone. Thank you for joining our webinar today. I'm just going to give people a minute just to start slowly filtering onto the session, and then we'll start at 2:02, if that's okay, Rob and Mark?
Yeah, perfect.
Okay.
Sounds great.
All right, we're also streaming live on Facebook, so we're just waiting for everyone to just come on.
Looks great. How's the weather in Peterborough, Bob?
Oh, gray and gray. Yeah, we've had our few days of our sunshine, and then that goes away, and everybody has a harder time to get up in the morning. So
that's it.
Yeah.
All right.
Okay, so if you two are ready, I'm just going to do a brief intro, and then Mark, I'll pass it on over to you. Okay, so good afternoon, everyone. Thank you so much for taking time out of your day and being here with us during this webinar. My name is Sandra, and I'm the marketing coordinator at TorontoJobs.ca. And today's webinar, we're going to be discussing the topic, how to generate 67% higher valuation for your business. Moderating the webinar is Marc Belaiche. He is a CPA, CA, and he is the president of TorontoEntrepreneurs.ca. And just two things before I stop sharing my screen here. We encourage everyone to ask questions. There will be time at the end, about 5 to 10 minutes, where you'll be able to ask any questions that you may have after the webinar. You can either post them into the chat or into the Q&A box that's at the bottom of your Zoom screen. We'll be moderating them throughout the presentation, of course. So, if there are quick questions that Mark or even I can help answer, we'll make sure to do that. And we are also recording the webinar, so if you would like to have a copy of the webinar, we can share that with you, and you can go back on any information that you would like that was discussed during the webinar. So Mark, if you're ready to go, I will pass it over to you.
Perfect. Thanks, Sandra, and thanks for coordinating and organizing today's event. Fantastic. Welcome to everybody, both live here on Zoom and also on Facebook Live. Great topic. I'm really interested in this, so I'm going to take lots of notes. I'm going to have some questions, Bob. I'm sure at the end, as Sandra mentioned, if you have any questions, you're watching, feel free to post them in the chat. You can also post them in the Facebook Live as well, and I'll be moderating them at the end. We'll probably finish around 2:30 Eastern time for Bob's presentation, and then we'll take about 10 minutes of questions. So if you have a meeting at 2:30 Eastern time that you have to run off to, no problem. But we'll stick around for another 10 minutes to ask any questions, or I'll moderate some questions here as well. So feel free to post them in throughout the presentation if there's something that you're not sure about, and I'll be sure to add them in to the list at the end. So Bob Gauvreau is our speaker today, our highlighted speaker. Great topic, how to generate 67% higher valuation for your business. So I'm wondering where the 67 and not 70 and not 60 and not 50. So I'm sure you'll cover that. Bob is a founding partner of Gauvreau Accounting, Tax, Law, and Advisory, based out of Peterborough, Ontario. So welcome, Bob, and looking forward to it. Thanks so much for being here today.
Absolutely, Mark. It's an absolute pleasure, as always, to connect with you and your community. So, guys, really excited to kick this off. I know we have 30 minutes, so I want to jump right in. Hopefully that's good with everybody. Yes, I'm going to talk about how to generate 67% higher valuation for your business. Why is this important? Well, at some point, we all have to transition out of our business, right? Whether it's, in the next year, 5 years, or whether it's 30 years from now, what we want to do is build not only a valuable business, but one that's has the ability to be sold. And that's the other factor that we're going to chat about today, because we can talk about that 67% more money or more worth and value in your company, but even, and probably equally as important, is actually creating a 67% more valuable company that can be sold and can be transitioned into a third party. I think this is so relevant for every business owner, because even if we're building for 20 years down the road, we want to know what a potential buyer is looking for and how we can maximize that value. Okay, so a little bit of a background. I'm going to make this short and sweet for us. Yes, Gauvreau Accounting, Tax Law, and Advisory. We focus on working with the small business and entrepreneurial community. That is it. We provide accounting, of course, financial reporting, so that we can get access to the banks and get them the reporting they need to get you funding. We have a bookkeeping department. We have a full tax specialty group that focuses only on business owners and how to position their corporate structures to make sure that they're as tax efficient as possible, not only for their business, but for intergenerational wealth transfer. We have included a legal department as well, looking at shareholder agreements, buy, sell, real estate acquisitions, private mortgages, you name it, focused around the small business owner. And we have this really unique program that is called the Virtual CFO program, where we come in and work one-on-one with business owners, not only to help them increase their business value by 67%, but also help them realize their $1 million year in whatever that means. If it's $1 million profit, $1 million sales, $1 million increase in company value, or just creating the capacity for your $1 million team, whatever it is, we're focused on building your $1 million year. So super excited to jump into this, guys, and add a ton of value to you and your business. We've been cited and most recently in Forbes quite frequently as a business entrepreneurial finance expert across North America. Although we are in Peterborough, Ontario, we do focus on serving businesses not only across Canada, but across North America as well. So super excited to add any value that we can to help you take your business to the next level. All right, so as a bit of a baseline, right? When we're talking about selling a business, we need to understand what that means. You know, when somebody comes in and says, you know, I think my business is worth $1 million, which we get all the time, right? Some people come in, they just say, well, I think my business is worth $1 million with no sort of backup. You know, what is the typical relationship with the value of a business to what's actually going on there and what a willing buyer is going to invest? So typically, and there are other ways, but typically the way that businesses are approached in a buy-sell arrangement is based on the earnings that they have inside their business. And the way that we look at that is based on a multiple of those earnings. So the average that we normally see is somewhere between 4 and 6 times earnings. So for example, if your business were to make $1 million this year and you got 5 times earnings, that would mean that your business is worth $5 million. And when I say when it makes $1 million, I mean net income before tax, before interest and depreciation, amortization. So that's a pretty typical approach. This is how much the company makes. We throw a multiple in there, and that's how we come up with a value for the business. Now, there's 2 criteria that we need to consider here. One, we talked about was, you know, the price, the multiple, right? Is it 3 times? Is it 4 times? Is it 5 times earnings? Because the more we can push that multiple up, obviously the higher you're going to be able to sell, the higher value you're going to be able to sell your company for. So that's super important. What are the criteria that pushes that multiple up? And the second is, what is the likelihood that you've actually got a business that's saleable to a third party? And this is really important because a lot of people are just assuming when they're operating their business that when the time comes, somebody is going to be a willing buyer and they're going to pay top dollar for their business. It doesn't quite work that way, right? And a disappointing fact is that most businesses, more than 50%, don't ever end up being sold. They're either shut down or they don't have an established value attached to them. Now, why do I say that? Because it's very, very important that these factors we're going to talk about will make your business saleable. And not only will it make them saleable, it will make it saleable at a 67% factor higher. Now, to answer Mark's question, why 67%? That's just the statistic. If you can start moving up in some of these factors, which we're going to talk about in a few minutes, the average when you start increasing some of these main factors gets you your 67% increase in value. So let's start looking at how this comes together. But first, let's take a look at the multiple of earnings, right? So we said somewhere between 4 and 6. In actual fact, the average multiple in a business sale right now, according to hundreds of thousands of reports across North America, is a 3.76 times earnings multiple. Now, we have a tool that's called the Value Builder Assessment, which identifies, and I keep referring to these 8 factors. We're going to go through all of them, but each of these 8 factors essentially gets a ranking. And if you rank really well overall, then you're going to have a greater likelihood that 1, it's going to be a saleable asset, and 2, that you're going to be able to increase your multiple. The statistics here show that on this Value Builder Assessment, which we're going to give you guys at the end, if you score less than 50, your multiple is 2.76. 50 to 60, 3.59. 60 to 70, 4.17. So somewhere in there between 50 and 70 is where the average business would land, right? They would land in there at that 3.76 times earnings, but we're not average, right? And if we're average right now, we want to know what it takes to be extraordinary. And that's what we're going to chat about, right? If you get a score 70 to 80, it moves up to 5.1 times. And if it's greater than 80, the average multiple is 6.27%. Guys, that is how we get the 67% higher value than the average business. If we can push up our Value Builder score, our 8-factor score above 80, and that's what we're going to show you today. Okay, so looking at this, right? We want to look at a return on investment with a Value Builder score of 60. Again, we're going to look at what that means shortly. With a Value Builder score of 60 at a 3.59 multiple, $800,000 pre-tax profit, or we call EBITDA, right? Earnings before interest, tax, depreciation, amortization. That would come up with a valuation of $2.872 million. That sounds pretty great, right? But what is better if we get a 90 Value Builder score? Again, we're going to go through this. 800,000 times 6.27, that's a $5.016 million company. So there are some factors here, guys, that are going to drive almost double the value of a business just by focusing on 8 key criteria. So I think I've built the suspense enough. Let's jump into those. Okay, so I'm going to give you this at the end, but what you're going to do is you're going to have the ability to go through. It's a free assessment. It's going to give you a rating on each of the factors. Why do we want that? Well, we want to know exactly where we stand and where our weaknesses are so that we can start focusing on it. But what we're going to do now is we're going to identify those 8 key factors. I'm going to talk about them. We're going to address them. And then when you go through and do your free assessment later on, you'll have an idea of what these mean and likely some key action steps to implement into your business now so that you can increase that value by 67% and make your business more saleable. The 8 factors, I'm just going to briefly go through because then we're going to go in detail to each and every one of them. First being financial performance. We've then got growth potential, reoccurring revenue, market control, owner dependence, relationship dependence, the customer score, and our cash requirement. So these are the 8 factors. If we can move ourselves up in having a better score in each of these factors, that is where we will drive an increased value in our business. Okay, the very first one, and this is where I come in a lot, right? I'm a CPA. I've been working with small business owners for 15 to 20 years, 15 in my own practice. And we essentially work with entrepreneurs to help them drive increased financial performance by understanding the mechanics of what comes into that. But when we're looking at a potential business that whether it's one of our clients looking to sell or it's one of our clients looking to buy, what we want to look at is a few key factors in financial performance. $100,000 of net income is $100,000 of net income. We use that kind of as a base, but what else is involved in that $100,000 net income? We want to know that that $100,000 that's being reported is reliable, right? One of the ways that we can look at reliable information is to make sure that their financial reporting process is actually really positive, right? Do they have a firm like ours doing a review engagement or financial statements that we know we can rely upon based on that reputation, that those numbers are reliable? Because what we don't want to see happen is if we go to buy a business and those numbers weren't truly represented and we're buying something and spending money on something that isn't valuable. So that is super important. As an internal person, right? If I'm selling my business, I want to make sure that the financial reporting that I have available to a potential buyer is going to be looked at as if it's trustworthy. So that's one area. The second is when you're a buyer, you want to buy something that has a low risk future. What does that mean? Well, that means that you've kind of had some history in there. You're able to go through and understand the business and see that, you know, it's got some stability, right? It isn't a one-year business that went from zero to, you know, $10 million, not knowing if it's going to drop right back down the next year. We want to see if there's some future, not guarantees, but some future certainty that sits in there with our revenue stream, with our clientele. And we're going to look at some of those and some of the other factors, but financial performance is certainly a major factor. The more we can get our company financially performing, you know, you take $100,000 times a 5-time valuation, that's a $500,000 company. But if we can get it up to $1 million in profitability times that same factor, it's a $5 million company. So there's certain elements of financial performance. We as a business need to drive it as high as possible. We need high profit margins. We need high overall bottom line income, and it needs to be reliable and consistent. And our reporting has to be reliable as well. So anyway, a few of the questions. Are your financial reports up to date? If they're not, we should be looking at getting our financial reporting up to date. This means your bookkeeping. Is your bookkeeping reliable? Are your banks reconciled, right? Anything internally that's sitting there, we want to make sure that that information is reliable, not only for a potential buyer, but for us as business owners, guys, we need to make sure that that's reliable information that we can make key strategic decisions on. So that's super important. Are your tax filings up to date? If you're a potential buyer looking at a company and they're not up to date, there's potential tax liability sitting there. And, you know, if they haven't filed in the last few years, they go to file now, all of those years are still susceptible to audit. It causes a little bit more risk, a little bit more future risk. That will downgrade the value multiple that we're going to be able to sell our company for. Do you have outstanding liabilities? And this is, guys, you know, is the company in a non-solvent sort of situation? Are there liabilities standing there? Is there maybe a reputation? Have there been wrongful dismissals? Are there potential liabilities that are sitting there that haven't been resolved? That would decrease the value of the company because the risk goes up, right? So these are all bases of financial performance. As a bit of an example here as well, you know, how do we come up with the 5 times multiple? It's all based on that risk factor. So this is an example of pre-tax profits. We use a 15% discount rate over 10 years. That comes up with a $500,000 valuation on a business, right? That's going to be the actual calculation of how we come up with the 5 times earnings. But what you need to understand is as the risk goes up, when the risk goes up, the value goes down. So if any of those factors we talked about, the financials aren't reliable, you know, the history isn't there, there's been late filings, employee related issues, any of those things increase the risk, which increases that discount factor, which decelerates the value of the business. So we want to mitigate risk as much as possible. That will help drive the multiples. I could talk about financial report performance all day. There's so many really great areas in there. We're going to move on to factor number 2. Factor number 2 is growth potential. So when we say this, we say, are you in a mature industry? Is your business in a mature industry? Is your industry growing or declining? What about your market share? Is there an ability to capture more market share? Or do you essentially own a lot of the market and there's really no market share that's continuing to grow as our population grows up, right? It's a set market. Is it a small market or is it a big market, right? What we want to see is the potential there as well. Are you able to capture more of the market if you deliver more? Will there still be buyers, right? So these are some key questions, but what we want to look at specifically as a question when it comes down to growth potential, we're essentially understanding and assuming that there's market there, we can continue to grow. So the question then comes down to, if 5 times the demand for what the company is delivering from a service or a product, if that comes up right now, how easily could you accommodate it? So this is what I want to show you. I'm going to show you some statistics here in a second. And this shows that if you are able to grow and scale as a company, you are going to have a higher valuation model than a company that couldn't adapt to that sort of growth, right? If you're not in a growing market, if there isn't a potential for 5 times earnings or 5 times revenue, or if you as a business can't scale up with extra capacity to deal with that, then your company valuation is going to drop. Here's an example of this. So this is, again, on the question, if we could accommodate 5 times demand, what would our valuation be? So again, the average multiple of every sale is 3.76 times earnings. If it would be impossible for your company to deliver 5 times more value right now, impossible, meaning we could not do it. Even if we had to scrap and claw, we couldn't do it. That would drop your valuation multiple down to 2.94, substantially less. If it was very difficult but possible, then it jumps up to 3.69, fairly difficult, but even more possible, 3.73. We're right there, we're right around the average, right? So the average business would have difficulty taking on 5 times more work, but maybe they could figure it out. Fairly easy, makes a big transformation. So we go from 3.73 up to 3.98, which is essentially four times earnings. That's, saying there would be challenges, but we could do it. We could take on that extra work, but very easy, jumps all the way up to 4.56 times. So this is a type of business that has the capacity, that can automate, that has the ability to grow and deliver and scale on a go forward basis. That type of company is really, really attractive to an acquirer. They're going to pay more money to acquire that type of business. That's factor number 2. Factor number 3, reoccurring revenue. What is reoccurring revenue? Well, reoccurring revenue is exactly like it says. It's income that comes in over and over and over again. Now, there's different types of reoccurring revenue. For example, I'm an accountant. We have accounting services that we offer. We have annual returns that we do every single year. That's great. But you know what's better than an annual reoccurring revenue? A monthly subscription, right? So annual revenue down to monthly reporting, monthly bookkeeping. If you think of your particular business, are there things you do annually? How can you do it on a subscription basis so that it automatically renews and you just keep having that generated income? If you can move to a subscription-based model in any of your type of revenue that you're delivering, they are going to pay more for your business and your valuation is going to increase. I've got an example here. On the left-hand side, we've got a security company. This is a $1 million a year revenue company that is both in securities, but have 2 different approaches. The one on the left is $1 million in revenue, and it's pure security installation systems, right? Cameras, alarm systems, everything that goes in there. That's all they do is they install that. Really a great service offering. When you sell a business like that, the case study shows us we're getting $750,000, right? On the other side, we're looking at this being 100% monitoring income. So they get a subscription on there and it's either monthly or it's annually, and people just keep renewing. There's no work required. So the cost of delivering that subscription drops as well, but it's reoccurring revenue. The reliability of that is really, really high. If we can move from anything to one-off service into subscription-based, the valuation will continue to increase and it can likely be automated and drive higher profitability. So in the monitoring business, we're actually generating a $2 million valuation versus $750. So substantially different, right? So super important to make sure that we're considering how we can transition our revenue to more of a reoccurring sort of guaranteed income stream. The other side, second graph, is looking at Amazon. Amazon's a great category or sample to look at because they've really owned the online space. Now, this is looking at some of the lifetime value of an Amazon customer, pre-prime and post-prime, and how much an Amazon customer would spend annually. So on average, an Amazon customer was spending $625. I don't know about you guys, but I'm pretty sure I was spending more than $625. So somebody else is bringing the average down. But once they introduced the Amazon Prime, that was the monthly subscription, what happened was Amazon customers actually started spending more than double, which was $1,500. So not only is it good from a prospective buyer, but it's going to drive greater results inside your business if we can move towards a subscription type model. Okay, number 4 is market control. What does market control mean? Do you have a differentiated product or service, right? So much so that maybe only people can get it from you. Do you have a product or service that you're competing on price where there's thousands of people who offer the exact same thing and people are just going to want the least expensive option? Or are there maybe a few competitors who all offer, a differentiated, specialized product or service that they can only get from a few places, right? Obviously, you can imagine if you are a business that offers something that's differentiated and unique and people can only get it from you, the value that somebody's going to pay for that business is going to be higher, right? You've got something, you've got an intangible market that has so much value because they can only get it from you. The potential for a buyer is that they can market this out to maybe new markets. Maybe they can cross market it to their existing customer base to get them access to something that only you can offer. So what happens in market differentiation? If we're different than everybody else, we can control pricing. So what does that mean? Well, if you're in a coffee shop right now and you offer the same old generic coffee as everybody else, it's $1. If you offer a premium brand or have an experience or the baristas and the culture of the place that you go into, you're charging $2 for a very similar coffee because it's a unique experience, because we've got that market of that particular clientele. They're not going for the cheapest coffee. They're going for the experience of that. If you've got that in your business, you can increase your prices. And what happens when you increase your prices because you're offering more value is that you get higher margins on those products, which means you're more profitable in your business, which means you're making more money, higher valuation, and the circle continues to go around. So market control is all based on differentiating yourself from all those low-cost competitors and creating something that's very unique and very sellable by only you, or taking that product that can be bought anywhere and creating an experience around it that is very unique to you. If you can create that experience and add that value, then you're going to have your market control increases, again, the valuation model. Let's talk about owner dependence. I feel like if I could see faces right now, I would say, how many of you do employees continue to report to and ask questions to on a daily basis? And I'm guessing, the majority of us would be in that position. So we all get in this little bit of a trap. We start our business or we buy our business, however we got started, and we start being the person who just delivers. We deliver, we make the sales, we have the key relationships, right? If only the business owner can deliver, this is an owner dependence issue. If I'm coming in and looking at your business, I'm essentially buying you and your relationships with your customers, but you want to leave, right? So how much value is in the business without you there if all of those relationships or those conversations go with you, right? The risk tends to increase if that's the case, which means that our risk factor and our multiple is going to drop down. So these are a couple of the issues, right? Only we can deliver, right? If only I have the skills to do the accounting in my business, I'm in a lot of trouble because I can't scale that and I can't help more people. What I need to do and what I have done is bring in and build a team of A+ players so they can deliver it. We systemize, we document, we build that out so that even if one of those A players leaves, we can replace them with another A player. That way, when the consumer, a potential buyer comes in and looks at this business, they're looking at it saying, you've got this A team that comes with the business, you're out. Does that impact the business at all? No. Great. We'll pay you a lot because now we as a new owner don't have to come in and fill that role. Are you as an owner interfacing with your clients? So one of the great questions that comes up is, do you know every single client that your company serves by first name? If you know every single customer by first name, then there's definitely an owner dependence trap that's in there. We need to start getting our team delivering and communicating with clients. If we can't do that, then essentially the business is buying us, multiple drops, the company's not worth as much money. If you as the owner are the primary salesperson, if you have great sales rates, fantastic, right? You're closing 90% of the deals and your next salesperson is closing 30% of the deals. We have to be able to transition that knowledge into the salesperson, because if you leave, then so too to all of your sales. Super important. Again, guys, this one comes up a lot, that we need to invest in building the team and building the processes out, because the short-term value of us doing everything is we're making all the sales. We've got all the retention. We've got all of the deliverables. We can do all those things. We can get quick results, but the long-term value gets capped when your capacity stops, right? So this is super important. We have to get out of this trap. Relationship dependence. So very similar. Is your company dependent on any key relationships? Is it based on key employees? Do you have a key employee that if they left, that the company would crumble? Do you have one salesperson who has a relationship with all your customers, and that if they went to a competitor, that all of the customers would go with them? That's a huge risk. If that's the case, we have to look at eliminating that risk. We have to introduce multiple salespeople, get processes and systems, get admin team involved in the ongoing communication, get the operations deliverable people involved in the communication, so it's not based on one key employee. Customers, do you only have one customer, right? Do you have 5 customers, or do you have 10,000 customers? If you're reliant on your revenue for one customer, there's a massive risk that if that customer leaves, that the business won't be financially viable in the future. We have to eliminate that risk. Same with suppliers. If you look at the car industry right now, anybody, so Ford dealership, Nissan dealership is dependent on those cars to come in. Well, if there's supply chain issues, as you can see on the dealership lots, there's no cars to be sold, right? Massive challenge. They have one supplier because they've got a dealership agreement. If they could buy from all of them, would that change? Well, maybe they would have, a few more cars on there. If they could buy and sell, different types of vehicles on their dealership that would be available, it could change. Or you start having suppliers competing with each other. If you have suppliers that are competing with each other, you get lower pricing, higher profits, higher valuation in your business. So we have to be careful of these relationships that are dependent inside the business to be successful, and we have to work on trying to transition them out. Customer score. We're getting close here, guys. So the customer score is where we want to buy a business where the customers are happy, right? And one thing that we do annually is we focus on getting a net promoter score from our customers. What's a net promoter score? How likely would you recommend working with our business to a friend or colleague? Now, fortunately for us, we've got a really high net promoter score to the point where we win client satisfaction awards, but this is something that a potential buyer would look at. When we have promoters, right? These are people who would actively go out and promote working with us. If we have passives, that means they're indifferent. They don't want to talk about working with you in a positive or negative way. They just, the experience is fine, right? Likely there, if you increase your prices, then maybe they look at other alternative arrangements. But the detractors are the big ones. The detractors are people who are still clients of yours, at least for now, that haven't left, haven't had a great experience, and they're out there telling everybody about that experience. So what we want to do with our customer score is we want to focus on getting those detractors up into passives, and from passives up into promoters. So how can we create an experience and an overall client journey that adds to the client satisfaction, continuing to test it, look at it, and make sure that we're improving it? Because if I'm buying a new business, I want to make sure that the customers aren't leaving. So one area that we need to assess is their customer score. And the last but not least is the cash requirement. This one makes a whole lot of sense. If I'm in a business that's a cash cow, like an online business, the orders are coming in, it doesn't cost me much to deliver, it all comes in, no capital requirements, cash is being produced in the business. I don't have to buy new equipment. I don't have to buy new inventory. I don't have to invest in infrastructure. If I don't have to reinvest all the cash all the time in building out the foundation for the next level of the company, that means I've got a bit of a cash cow. And you guys have all heard the old adage, cash is king. It's totally true. If you've got really great positive cash flow in your business and it continues to go into your bank account, as a potential buyer looking at your business, they want to see a company that they don't have to continuously go into their pockets and put money in. They want to see it coming the other way. That just means they're going to get a good return on their investment. So cash entering the business, we want it to be high. Cash exiting the business, We want it to be low. There are ways that we can continue to focus on cash flow management inside our business, but the more cash that we can have retained in there and the less capital requirement to reinvest continuously is going to be a big impact in the valuation of the business. And the more that positive cash is in there, the higher the multiple is you're going to get. Okay, I've got through there's the 30-minute time that I'm right at here. I have a gift for you. For anybody who's watching or anybody who's going to watch the recording, it's going to be available to you. I have a document that has some more details about the 8 oversights driving down your business value. So these are the risks that sit in your business, guys, that every single day are driving down and making you not have a business with its full potential for an eventual sale or the likelihood of a transition to a third party. So super important. If you text value to that 705-710-9540, you're going to get that free download. As well, I mentioned looking at your assessment, looking at your score, seeing where you land right now. You're going to get an access to a link to go through, get that free assessment. It's an automated report with a tool we have. It's going to come back to you. You're going to have an idea of where you're at and what your weaknesses are so that you can focus on increasing your value by that 67% and ensuring that you have a successful transition or exit from your business in the future. Hopefully that was super valuable, guys. I'm going to stop the share now, and hopefully Mark and I can answer any of the questions that you guys may have throughout the event.
Well, that was great, Bob. We do have a couple of questions, and if you are watching, you have a couple of questions or any questions, feel free to put them in the Q&A or in the chat, and I'm happy to moderate. So that was really great, Bob. Lots of great information. I did actually text it as well, so I got a response from you already. So text value, I'll put it in the chat here as well. So where to text. But anyways, first question, you kind of mentioned it. Maybe if you want to talk about it, anything else. Henry here says, what process do you go through to assess the appropriate multiple for a business? So you kind of talked about all the different factors. Of course, you went through the different steps. Anything you want to add to that? It was an earlier kind of question, so maybe you kind of really, as I was listening to you, you answered a lot of those questions anyways, but.
Yeah, and hopefully I did. And really it is on those 8 factors. So when I'm looking as a potential buyer for a business investment, I'm looking at all of those 8 factors to say, where does the company stand, right? Is there financial performance? Is it reliable? Yes. Is there high risk associated with it? No. Okay. This looks like a business that has reliable information. I would be willing to pay more than a business where you go, geez, I don't know, the reporting's not up to date. Their tax filings aren't done. Their internal bookkeeping's a mess. That's got some risk tied to it. Right. So each of those 8 factors, and for sure download that brochure as well, that'll have those 8 risk factors. If you can eliminate those 8 risk factors from your business, you will be moving your business up in value. And not only eliminating some of those risk factors, but presenting your business in a positive light. Right? It can show all of those 8 factors and how we started moving them forward, which shows a good upward swing in the future as well. So all of those factors will result in an increased multiple all the way down. I know, the statistics are saying 3.7% ish is an average, in Peterborough market, Toronto market, and across Canada, I'm seeing 4 to 6 as a base, but those are the average. I've also seen, 10 to 15 times earnings as well. Specifically with companies that have a really, really high cash flow, really high profitability, reoccurring revenue model, and no owner dependence. So, it is really possible to get a big win as an exit, but you as the owner have to be removed. It's not going to be a successful transition if you're still a key core element of that business's success.
Right. So I guess with the value builder score assessment, I want to make sure I get the right wording. But with that value builder score assessment, do the 8 categories, is there one higher? And there's a question here: does industry affect the multiple? So I know you talked about that during the presentation, which it does, of course. what industry. There are multiple factors, but maybe more of a broader question. Do the 8 categories that you talked about, is one far greater in value and point score than something else? Maybe you can talk about that, or are you trying to get people to get the builder?
No. I'm like, absolutely get it done, because it's going to give you an assessment of where you're at. But no, I'm happy to chat about that. And yes, industries are completely different. And, there's some factors in all elements of those that, we have to tie in the industry. We're looking at, if you think of like a medical doctor, for example, their businesses don't really have a value because it's not transferable, and there's no growth potential, right? And, any doctor off the street can walk up and go in and pick up all the patients they need. So it's not really transferable, right? But you look at even an online coaching business that just has online sales, like Amazon, for example, where they've got all their infrastructure in place and people are just going in and putting their products on, and they've just got this really, really great network and system in place. Like Jeff Bezos isn't running anything over there. Is he involved in strategic decisions going forward that involve cash investments? Absolutely, and massive strategy. Yes, but he knows nothing about how that platform is likely built or how those changes happen or anything. And, I think that's super important to understand as well. So industry does impact it. I would say, if you go back to the number one factor that we talked about, or the very first one, it's financial results. And if your company has 10 out of 10 in all the other factors, but it doesn't make any money, your company is not worth anything, right? Because why would somebody invest in a company that doesn't make any money? Now, you might be able to, there's certain elements that you can pull apart of your business that people will pay for. A good example is tax losses. We have clients who've gone in and bought tax losses that people wouldn't be able to use, similar business, right? But it's not a value of their business. It's just the fact that there's a value related to their losses. So the biggest thing for me is, how do we make you go from $100,000 a year to $200,000 a year in net income by coming in and finding greater efficiency, looking at pricing strategy and saying, how do we make more money off of doing the same transaction? We eliminate any non-essential expenses, drive that profitability, because regardless of the factor, if you make more money, that times whatever factor, your valuation is going to continue to go up. So that's, for me, when I'm looking at my businesses, I want to make sure that that profitability factor is as high as possible, because that's going to drive the highest result.
Right. So one more comment / question, and then we'll wrap it up. So when you were going through the presentation, I almost seemed like I was thinking of a technology company, and how, on each one of those, it almost seemed like, it met as many of those 8 criteria as possible. You got financial performance, presumably, you got growth potential, recurring revenue, subscriptions, market control, all these things, is not reliant on an owner. So I take it that a tech company would probably score highest in these things. And to that point, with Uber having a lot of losses, their share prices and market cap is significantly, a lot higher than maybe another company. So maybe you can just talk about a tech company, and whether it's a startup or more established, and they score higher points, I guess, right?
Totally. And so a really great example is Tesla, right? They found a niche market. They own the battery powered car market. For the most part, there's some small competitors that came in, and they didn't make money until I think maybe last year, but their valuation kept going up and up and up. One, because people wanted to be there, and people wanted to be part of it. So they had this sort of unique ability. The growth potential was massive. So knowing that everybody who drives a car could be driving a battery car, knowing that that's, the way the world is going is more environmentally friendly, and we need to continue to be conscious of that. It's driving all the other dealers towards creating electronic vehicles, but their financial performance was way negative. And they had to keep pulling in shareholders and venture capital money to continue to fund the development. So in that case, right, the tech company is going up in so much value because of its future potential, because of its its new online retail platform was super easy for customers. They had more orders than they could fulfill, right? There were just so many factors in there, but they weren't making money. So you can still have, 7 of the 8 and have a valuable business. But Tesla's challenge is to now go, okay, how do we get that 8th one? Because if we can get turning profits, one, we have a long-term sustainable business, which is nice. But 2, if we can get that other factor in play, it's going to increase the multiples and the valuation model of the business again, because we can now see that it's making money and it's got a reliable future. So a lot of them aren't in silo. You can have, individual factors that are really strong. And maybe in your industry, you have a particular challenge for, growth potential. Or a subscription type model of reoccurring revenue. Maybe that's a bit of a challenge. But what the goal would be is to try and move those factors as far forward as we can, and then really hit home the ones that we can control. Because if we can continue working, and I always say, small incremental changes win the race. Right? If we can just continue to make those small incremental changes, you maybe have a score of 50, we get you up to 70. That might be an extra $1 million in your pocket just by some small incremental tweaks. Everything doesn't have to change overnight, but we need to come up with an action plan to improve things going forward.
That's great. Great advice. Thanks everybody for being on. I know there was a question here from Marc about the recording, so we'll get the recording out, and it's also being broadcast right now on our Facebook Live on TorontoEntrepreneurs.ca, and also it'll be on our YouTube channel as well. So it'll definitely be around. Thanks very much, Bob Gauvreau, founding partner of Gauvreau Accounting, Tax, Law, and Advisory. Bob, how does someone get hold of you, or how, if they wanted to get more information or wanted to talk about a purchase or a sale?
Yeah, for sure. So a website is GauvreauCPA.ca. And any of our social handles are the exact same at Gauvreau CPA. You can find us there. We're online. We're getting cited all over the place. So if you look my name up, we'll be able to connect.
Awesome. Thanks very much, Bob. Happy holidays to everybody, to yourself. Here's the great 2022, and signing off, and feel free to connect with me as well. I'm on LinkedIn if there's anything I can help you out with. My name is Marc Belaiche. I'm president of TorontoJobs.ca and TorontoEntrepreneurs.ca. And have a great holiday. Best wishes, Bob. Thanks so much.
Thanks, everybody. Thank you, Marc.
Thank you.